Every number in a business tells a story. But here's the secret. That story is never written in just one place. It's scattered across three powerful reports: the balance sheet, the profit and loss statement, and the cash flow statement. If you can read these three together, you can see the heartbeat of any business, where it's been, where it stands, and where it's going. Today, I'm going to show you how these three connect through the story of one fictional business. Meet Sunny Brews, a cozy coffee shop run by Maya. She's passionate about brewing the perfect cup, but when it comes to the numbers, she relies on her bookkeeper, Sam, to keep her business healthy. At the end of every month, Sam prepares three financial statements. They're not just random spreadsheets. Think of them as the three chapters in Sunny Brews' monthly financial story. Chapter 1, Profit and Loss Statement, P&L. This is the performance chapter. It tells us whether Maya's hard work this month actually paid off. In July, Sunny Brews made $20,000 in sales. Subtract the cost of beans, milk, barista wages, rent, and utilities, a total of $12,000 in expenses, and we see an $8,000 profit. That's the scorecard for how well the shop performed over that month. But here's a question. The P&L shows $8,000 profit, so does that mean Maya has $8,000 sitting in her bank account? Let's find out in the balance sheet. Chapter 2, Balance Sheet. The balance sheet is a snapshot on a single day, July 31st in this case. It shows what the business owns, assets, what it owes, liabilities, and what's left for the owner, equity. For Sunny Brews, assets include $3,000 in cash, $7,000 in account receivable, $5,000 worth of coffee machines, and $2,000 in inventory. Liabilities include $2,000 owed to suppliers and $1,000 on a small loan. The difference? Assets minus liabilities is Maya's equity in the business. Now you might notice something. If the P&L says there's $8,000 profit, why is there only $3,000 in the bank? That's where the third chapter solves the mystery. Chapter 3, Cash Flow Statement. This statement tracks the actual movement of money in and out of the business. In July, Sunny Brews had $20,000 in sales, but $7,000 of that is still sitting in accounts receivable, meaning only $13,000 actually came in from customers. On the expense side, the shop incurred $12,000 in costs, but $2,000 is still unpaid to suppliers, so only $10,000 actually went out of the bank. When you put it together, the net cash increase is $3,000, the same amount you see sitting in the bank account on the balance sheet. This is why cash flow is so powerful. It explains why Maya's profit on paper, $8,000, is different from the cash she can actually spend, $3,000. The three statements are like puzzle pieces. Profit from the P&L flows into the equity section of the balance sheet. Changes in the balance sheet accounts explain the movements in the cash flow statement. The cash flow statement shows how profit translates or doesn't into cash in the bank. If you only look at one statement, you only see part of the picture, but together they reveal the full business story, whether it's growing, struggling, or coasting. Now imagine being able to read these statements like a professional, spotting cash flow problems before they happen, advising business owners with confidence, and connecting numbers into clear, actionable stories. That's exactly what you'll learn in Account Tutor's Bookkeeping and Accounting Playbook.